You've probably been there before. You set up the trade, you define the stop loss, everything well calculated. But then the price gets close to it and your mind starts screaming, it's gonna bounce back, just hold on a little longer. And what happens? The price doesn't bounce back. The loss doubles. Guys, the problem wasn't the technical stop, it was the emotional stop. The one almost no one talks about, but that destroys more trading accounts than any poorly designed setup. Before we continue, in case you don't know me yet, I'm Chad from ZERO Markets, and here you always find content that's going to make you smarter and more critical with direct information and no fluff. Every trader knows that the stop loss is an essential tool. It's the simplest way to protect capital and limit your risk. But what separates a consistent trader from a reactive one is the ability to respect their own limits. What few realize is that the stop loss isn't just a number on the chart. It's a psychological decision, the line that divides discipline from despair. And that line is often crossed not because of technical errors, but because of poorly managed emotions. Deep down, a trader's greatest battle isn't against the market. It's against themselves. The human brain was shaped to survive, not to trade charts. It's programmed to avoid pain and seek immediate pleasure. But in trading, that biology turns into a trap. You see, when the market moves against you, your body interprets it as a threat. Your heart starts to race, your breathing starts to get faster, and it changes. Your thoughts start to get blurry. And the first reaction is to deny the loss. It's going to bounce back. Just wait for that one more candle. But the market has no empathy. While you wait, the loss grows. And when you finally accept the mistake, it's already too late. This is the emotional stop loss, the failure to accept reality. It's the moment when the trader stops following the plan and starts trading driven by fear, pride, or hope. Let's illustrate with two different traders. The first is technical. He's disciplined. He sets the stop loss before entering. He knows how much he's willing to lose, and he accepts that loss as part of the game. The second is emotional. He also sets the stop, but in the heat of the market, he changes the plan. It's almost hitting, but it will reverse. And when the price breaks the limit, he expands the loss. Gradually, control slips away, and the capital goes with it. Now, here's the most painful point. The second trader might even have better setups, but without emotional control, there's no consistency. Ray Dalio, one of the greatest managers in the world, says the secret to success lies in quickly learning from mistakes. But the emotional trader doesn't even see the mistake. He tries to justify the mistake. And while trying to be right, he forgets what really matters, preserving capital for the next trade. According to Daniel Kahneman, Nobel laureate in economics, the pain of losing is psychologically twice as intense as the pleasure of winning. This means that for the brain, losing is almost an existential threat. And this pain causes traders to act irrationally, moving stops, canceling orders, and self-sabotaging. Another psychological phenomenon that comes into play, confirmation bias. When a trade goes against them, the trader begins to seek any information that confirms the reversal will come. They stop analyzing the chart and they start defending their ego. Now, at this point, the market has already won, not at the price level, but in the mind. First, it's important to understand the stop is not a defeat. It's part of the strategy. It's the entry price to keep playing. Okay, before I tell you the 3 pillars to help you maintain control, like this video and subscribe to the ZERO Markets channel to stay informed about everything you need to know about the market. So here's the deal. Planning is the base. Every trade needs to start with a defined and respected risk limit. Next, focus on size management. If the stop seems too large to bear, then the problem isn't the stop, it's the position size. And lastly, acceptance. Losing is part of it, guys. No trader accepts that. It's curious, but the traders who survive the most aren't the ones who get it right the most. They're the ones who fail well. They fail fast, they fail small, and they always learn. The technical stop loss is what everyone learns. The technical stop loss is what everyone learns. But the emotional stop loss is what almost no one masters. And it separates those who survive the market from those who just try. Controlling emotions is not a luxury. It's a matter of financial survival. A consistent trader isn't the one who always gets it right. It's the one who knows when to stop. Remember, In the market, control is never about predicting the move. True control is about not losing yourself when the market moves against you.